Now let's take a look at, again, some questions regarding Chapter 1. Um, we're still covering it this week, and we're getting to Chapter 2 next week. Here's an example, again, of one of the problems where they want us to analyze the effects of financial transactions. We won't cover all of them because, again, this is a repeat, but again, I just want to make sure you understand, so we'll go over a few of them. Lita Lopez invests $70,000 in cash, and she also invests office equipment, and the office equipment is valued at $10,000. So her total investment is $80,000. Cash goes up $70,000, equipment goes up $10,000, and equity goes up $80,000. As you can see here, around here, excuse me, around there, okay? Keep that in mind. In a business, you can invest cash, or you can invest other assets also, not just cash. You can invest equipment, you can invest office furniture. If you have office furniture, you say, okay, this desk is now going to be, I'm going to give it to the business. So now it becomes a business desk. Well, that's an investment also. So investment need not only be cash. Keep that in mind. The company purchased an office suite for $40,000 cash. An office suite, think of it as like an office building, is an asset. So cash goes down by $40,000, but the office suite, which is an asset, goes up by $40,000. As you can see on the next line here. Equity remains the same. Well, let's do just a couple more and then we'll move on. Because again, I explained this thoroughly in the PowerPoint slide and also in the previous lesson that I put on YouTube. The company purchased office equipment for $15,000 in cash. So cash goes down, but office equipment also goes up. Okay. Office equipment. Oh, that's the balance. Let's go there. Okay, yeah. Cash goes down by $30,000. Equipment goes up by $15,000. Now let's do one more. D. The company purchased $1,200 of office supplies and $1,700 of office equipment on credit or on account. On credit is the same as on account. So what goes up? Office supplies goes up by $1,200. Office equipment goes up by $1,700. And accounts payable, a liability, goes up by $2,900. See it right here. Office supplies goes up by $1,200. Office equipment goes up by $1,700, and then you have the liabilities go up by $2,900. So both sides still equal. Okay. So I think we've done enough. To give you an example there. Well, let's see. Something let's look at E. The company paid a local newspaper $500 cash for printing an announcement of the office's opening. So that's an expense. So cash goes down by $500. Expenses went up by $500. But don't forget, expenses going up makes equity go down. So let's take a look at that. Again, cash goes down by $500. And as you can see, expenses went up by $500. And typically they should have that expenses go up, but as you'll see, it's going to be subtracted at the end because expenses reduce equity. Revenues increase equity. Sorry for my doc there getting in the way. Okay, let's move on to another problem. Okay, here we have again some information here. This is something we call this is a list of the accounts and their balances. It's a consulting firm. The owner contributed $84,920 in cash, in assets rather, to launch the business. And you can see that number here. On October 31, this is what's happening. This is what has happened over the past month. Okay, withdrew that much money, not much in sales, this much in expenses. So what do they want us to do? Prepare an income statement. Now, based on what my previous lecture contained and the narrative I added or the audio I added to the PowerPoint slide for Chapter 1, you can look at this the way they've ordered it, which is the proper order. This listing up here is the proper order, and you'll learn more about that later. Which of these accounts belong on an income statement? Answer that question to yourself. Obviously, I can't hear you, but you need to answer that question. Just look at this. Now, they made it easy for you. But what if on an exam I had them all mixed up? No particular order, just all mixed up. Would you be able to pick out the accounts that belong on an income statement? Well, here they've made it for you easy. Consulting revenue, and then these expenses. And you're going to add up the expenses and subtract them from the consulting revenue and put them in the proper format. What is the proper format, folks? Look here. The name of the company, number 1. Number 2, the name of the financial statement. It's called an income statement. And 3, the period in which it covers. Don't forget, all financial statements except for the balance sheet cover a period of time. And you must indicate what that period of time is. Is it a month, a quarter, a half a year, or a year? In this case, it's a month, for the month ended. And so we have the $14,910 as revenue. There's no other sources of revenue. Sometimes the company has more than one source of revenue, so you list them all and add them all together. These are all the expenses that come from that list above. You add those expenses up, and then you subtract it from the revenue, and this is the net income. And do not forget, I want to emphasize, do not forget that sometimes you may have a loss. The expenses may be greater than the revenue, and therefore the net loss would be a negative number. Typically put in parentheses, but it could be a negative number. Now we have net income of $1,050. What's the next request? Prepare an owner's equity statement, which is the proper one to do, because after you construct an income statement, then you have to take that income and incorporate it in the statement of owner's equity. Again, it covers a period of time, as you see here. And so we start out at the beginning of the month with 0. Sometimes the beginning of the month may have a balance in there, because here we are starting at the a new business, but it won't always be 0, because the following month is going to be whatever the balance is from the previous period. Anyway, The owner invested $84,920. That comes from this right up here, see? And then you add the net income, and you're going to subtract the withdrawals. The withdrawal, $2,930. Here it is up here, okay? And then therefore, that will give us a new balance. So here, we take the investment, add the income, and subtract the withdrawals. If we had a loss, you subtract it from the investment. And you always subtract withdrawals. So now this is the new capital account. And by the way, it's been a decline because he took out more money than they earned. The company earned $1,050, but he withdrew twice that amount, almost 3 times that amount. So the net capital is less than the original one, and that happens. So this is the new capital account. This number here, $83,040, is what we're going to use in the balance sheet, which probably should be the next one they want us to do, yes. And don't forget, a balance sheet does not cover a period of time. It is a moment in time. It is a date, a specific single date. Okay, and I expect these headings. On statements I ask you to do. Here we have our assets on one side. And look at this new capital balance right there, $83,040. It's a new amount. And these are all the other numbers come from above, come from the original part of the problem. All the numbers here were listed up above, except the capital we had to calculate. So every single number here came off the list at the top, right there. Okay. All right, and let's go with the last of these problems. Again, prepare an income statement. Which means you have to pick out now what belongs in an income statement. Look at this. Which of these items do not belong on an income statement? I see 1, 2, 3 that do not, and 4 that do not. Do you know the 4? Equipment does not belong on an income statement. That belongs on a balance sheet. Cash does not belong on an income statement. It belongs on a balance sheet. Accounts receivable does not belong on an income statement. It belongs on a balance sheet. Those are all assets. Equipment, cash, and accounts receivable are all assets. Accounts payable is a liability. It does not belong on an income statement. It is on a balance sheet on the liability side. So the rest of those are income statement accounts. And here they are. You see? And a net income of $4,000. Okay. I think that's it for this one. So let's get out of here. I'm trying to get out of here. Okay. This is the way I have to do it. I'm sorry.